Well, hello and welcome to Bloomberg Kuwait. Wish all our viewers a very happy Diwali and a year of unlimited happiness from the entire team of Bloomberg Kuwait. But Samvat 2072 was all about the GST bill passage, the declining trend in the interest rates and a good monsoon. But what does Samvat 2073 hold?
Right, so we have a lot of guests joining us today who will give us an idea of what we are going to do, what the ideas that can be implemented, and all the challenges that the Indian economy faces going ahead. And in the lineup, we have the likes of Ramesh Damani, we have Nilesh Shah of Kotak, we have Nilesh Shah of Envision, we have A. Balasubramaniam of Birla Sun Life, and along with that, plenty of others like Dipen Mehta as well as Deven Choksi, who will be telling us all about things and stocks that we can watch out for in today's day of trade and as well as this Samvat.
That's correct. But Agam, before that, let's just have a look around as the full hall, the Bombay Stock Exchange Convention Hall is filled with traders and their families. A lot of excitement and festive mood that we can really see. People are all excited to execute their first Muhurat Saudas. So we hope the next year also just looks exactly like that. But Agam, just talking about Samvat 2073, I just have a question. Can you actually say 2073 in Gujarati?
Yes, I think I can try. 2073.
I'm not sure what is correct, but I am going to go around and ask somebody over here. I'm sure is going to give us that answer. But let's take a recap of all the movers in Samvat 2072. So if you look at the Nifty, that was up about 10.5% for the last Samvat, and the Sensex rose about 8%. In terms of the large cap gainers, we have Hindalco and Tata Steel with gains of 83 and 86%. Surprising names there, Agam, given that they belong to the metal sector where demand has been very lackluster.
Right.
But it's the duties, import duties, and also controlled production from China, which has really led to the kind of gains that we have seen. Gains, of course, have come in the latter half of the year. Yes Bank, Gail India, BPCL, some of the other gainers with gains of anywhere over 50%. On the losing end, we had Idea Cellular, that stock lost about 42%, followed by BHEL, Lupin, Tech Mahindra and Wipro, all of them seeing their prices erode by anywhere between 17 to 22%.
Right, with respect to gainers in the mid caps, we have Manappuram Finance along with a lot of other finance companies which have done very well. So, but the likes of Manappuram Finance has actually gained as much as 335% just in this one Samvat. We have good gains in Dalmia Bharat, Escorts among the automobile sector, V-Guard Industries as well as Delta Corp, all of them gaining well over 125%. With respect to losers, we have seen a lot of weakness in Alok Industries, of course, which is now a penny stock. It has declined by as much as 49%. Marks's Pharma, well, we had a lot of volatility in this particular counter, and we have seen about a 47% decline as far as this stock is concerned. Just Dial, once again, continues to show weakness, down as much as 46%. Inox Wind, along with Wockhardt, also losing out 43% each. Now, we have to remember that, there has been a lot of volatility in these stocks, and they have seen bouts of spikes, but it remains to be seen, Shraddha, whether or not we see a little bit of a recovery moving in this summer.
That's correct. Agam, we are just waiting for the markets, the pre-open trades to start, and I'm just waiting to hear those BSE bells ring. But after that, we are going to be joined by Nilesh Shah, the MD at Kotak Mutual Fund. Should we start with him?
Yes, absolutely.
Nilesh, thank you very much for joining us. A very happy Diwali and a prosperous New Year to you from our end.
Thank you for your wishes, and I wish all the viewers of Bloomberg Quaint a very happy Diwali and a prosperous New Year. Sal Mubarak to all of you.
Well, Samvat 2072 had its share of volatility for the Indian markets, where the initial few months were marked by a sharp selling, and then post-budget, the bulls took charge. Now, while GST bill and the real estate bill were some of the key themes of last Samvat, Nilesh, what could be the key drivers of Samvat 2073?
I think the only driver for equity market in any part of the world in any year is the earnings growth. And in 2072, we have seen prices moving up on the basis of hope that earnings growth will happen. And I think in Samvat 2073, Samvat 2073, earnings will have to be delivered. As long as earnings growth materializes, markets will remain supported.
So how has earnings panned out, and what are your observations with respect to the second quarter, and what can you expect moving in ahead?
When we look at earnings season, we have to disaggregate the aggregate numbers. The largest market cap company of India, TCS, declares about 6,200 crores in a quarterly profit, and the growth rate is about 200-300 crore. One PSU bank can declare 6,000 crore loss and wipe off all the profits declared by the largest market cap company. So we need to disaggregate the numbers in order to arrive at your portfolio picks. Clearly we see today in FMCG sector, in technology sector, in some of the pharma companies, in some of the mid caps, the earnings growth trajectory is coming below expectations of the market. We are seeing in sectors like consumer durables, automobiles, auto components, private sector banks, especially retail focused, where earnings are coming either ahead or in line with individual expectations. My recommendation will be to pick up stocks where you believe earnings growth trajectory will be higher than what is priced by the market in order to make money in SY 2073.
Well, Nilesh, the retail-focused private banks have actually outperformed in terms of earnings even this quarter. Axis Bank, of course, it seems that the worst is not yet over. Whereas in case of HDFC Bank, the management did say that they have not yet seen a pickup when it comes to the corporate credit demand. What does that really mean for the banking sector's corporate credit demand and the bad loans, and hence the outlook for these banks?
So essentially we'll have to divide banking and financial services into 3-4 compartments. At one extreme is the NBFCs and microfinance institutions and small banks. Clearly here one will have to be selective as valuations are reasonably high. In fact, they are at the higher end of their valuation range, historical valuation range. So be selective in NBFCs and microfinance institution space. At the other extreme is the PSU banks, which are looking cheap, but they have rallied significantly in last 6 months, especially post-budget. Now here again one will have to be extremely selective despite the apparent cheapness in the valuation, as these banks are now expected to run up on the treasury profit made on the falling interest rates. But those analysts are ignoring that the PSU banks have largely unfunded pension liability. As interest rates come down, while they do make money on the treasury side, they lose money on the pension fund side. So in PSU bank, again be selective like NBFC and microfinance institution. Then that leaves the middle of the compartment, which is retail focused private banks and corporate focused private banks. We believe the NPA cycle, the worst is not completely behind us. There has to be some more recognition out of CDRs, SDRs and S4As kind of provisions which we have made in the past. So we believe today retail focused private banks will be more of a compounder, more of a value creator, and after correction the corporate focused private banks will be probably an opportunity to buy.
Well, we know that it's been a season of exits, particularly in this case specifically Cyrus Mistry. But I want to focus on the banking space, and considering we are still looking at a problem of NPAs and a lot of other piling problems, not just in PSUs but in private banking as well. Do you see a case for reshuffling in the senior management?
I think when we are looking at banking and financial services sector, we'll have to differentiate the NPAs from where the promoters have been siphoning of money from the company, or promoters whose business environment is deteriorated due to a variety of factors. If a promoter whose steel company has gone into bad time because steel prices have crashed, then obviously that needs to be treated differently vis-a-vis a promoter who decided to set up a steel plant, and the project cost of setting up that steel plant is 2 or 3 times more than what should be warranted because he has kind of gold plated the project. It's very easy to brush everyone with one color, but we need matured behavior in analyzing the reasons of NPA. Then we have to create a resolution whereby we back honest promoters, where we back hard-working, disciplined promoters, and at the same time we punish, promoters who haven't behaved as per the moral and legal expectations of the law. So don't paint everything at one brush, one color. We need to resolve NPA problem not on a generic basis, but on a specific basis.
Well, Nilesh, last month when we spoke, you actually told us that you prefer to be invested in consumption stocks right now rather than industrials, and that is given the fact that despite them being expensive, that is one space where we're actually seeing some sort of earnings growth. So I just want to understand what has been your reading on the festive demand, and how are you viewing some of the consumer discretionary stocks now?
I think when we talk about consumer, we are talking about a very large sector. Our essential theme about consumption is that today, courtesy the good monsoon and good kharif crop, rural economy will spend more money than what they've spent in last 2 years. On the urban as well as rural side, more than 1 crore central government pensioners and employees will get 7th pay commission money over a period of time. That money will be spent on consumption. And third, the urban consumption might also get boosted with overall economic growth picking up. This is going to create a consumer boom, not only in consumer discretionary but also consumer non-discretionary. If I take on one spectrum, we have automobiles where 6th pay commission recipients who would have bought automobiles, two-wheeler, four-wheeler in 2010 might be looking for replacement in 2016 and 2017. So auto component and companies which are financing automobile consumption should be bought from that point of view. On the other hand, with the rural and urban consumption getting lifted, there will be spend on consumer durables, there will be spend on travel, entertainment, there will be spend on education, holidaying and stuff like that. The other area where this kind of consumption lift will be witnessed is home improvement or home purchase. In home purchase, rather than playing real estate developers, we will rather play cement and cement materials companies which are key beneficiary of this real estate construction. On the home improvement side, you have paints, furniture fittings, consumer electronics and so on and so forth. When we are talking about consumer, we are trying to cover the entire spectrum where people who have benefited from good kharif crop, recipients who have received 7th pay commission money and the urban consumer are going to spend their money.
Well, with that, can you just leave us with at least 2 ideas, it could be thematic or sectoral, that traders could work on going into this coming year?
The one thing which we are bullish upon and where you will probably get a good entry point in Samvat year 2007 is pharma space. In pharma, we are expecting re-rating to happen over 3 compartments, over 3 distinct time periods. One will be the time period of 6 to 12 months, hopefully next Samvat year, where some of the companies who have lost their US FDA registration for their factories will start receiving that registration back. The second phase will begin when those companies who have received their factory registration to export medicines to US market will start filing applications for exporting the generic medicines to US market. And the third phase and the final phase will be when those applications will be approved by US FDA and they'll make actual money by exporting those generic medicines into US market. These 3 phases will be played out over probably next 3 years or 4 years. But market at different points of time will ascribe certain value to, one, the factories getting approved, second, sufficient applications getting filed, a pipeline getting built, and third, the pipeline actually getting converted into cash flow. It's impossible to time this particular cycle to the perfection. So our recommendation to viewers will be try to do an SIP into pharma sector, pharma stocks, pharma fund, pharma PMS, buy a portfolio, but play for this 3 distinct cycle in terms of factories getting approved, applications getting filed, and products approvals actually resulting into cash flow. This is one sector to be considered, considering the fact that valuations have come down, prices have corrected, and there is potential that defensive flows from technology sector as well as consumer staple sector will move towards pharma sector over Samvat year 2073.
Thank you so much for joining us, Nilesh Bhai. Next joining us we have Mr. A. Balasubramaniam, the CEO at Birla Sun Life Asset Management Company. Thank you so much for joining us and wish you a very, very happy Diwali firstly.
Yeah, it's my pleasure, and let me also take this opportunity to wish all the viewers a happy Diwali and great year ahead.
Since we're in the midst of the earnings season, let's start by you telling us what has been your reading of the numbers that have come out so far.
I think the way things have been evolving, I think this year seems to have been a little better year from multiple angles. One, there has been a pickup in the general consumption demand, and not necessarily, of course, is substantially higher than what was in the past, but at least the trend has been a little on the upside. I think the reason could be one, the better monsoon that we have seen in the first half of this year, and that seems to be actually building up momentum actually for rural economy. And second is the government has rolled out that 7th pay commission. After a very long time, they are now given out that, as well as the one rank, one pension, also has given more money in the hands of people. Therefore, if you look at the spending pattern in the country in the last few years, and this year probably I would say is one of the best year, whether it is you take the two-wheeler sales, or the car sales growth, or maybe the air conditioner sales growth, or even the fridge, which is the consumer durables goods items. So there has been some kind of pickup. At the same time, we've also seen clearly one of the macro variables we all look at is the Mengai, which is inflation, and how the inflation has been coming down. So this year clearly we have seen inflation coming down, which essentially means from the consumer point of view, even the interest cost, which is one of the biggest component in the overall cost structure, whether it is for the corporates or for the individuals, and they're also showing a dip. So therefore, if you have to sum it up, the momentum has been good. And I think the better outcome is yet to be seen, given the fact that the second half of monsoon also need to be measured, and the output of the whole agriculture income will be felt only between Jan to February period. So therefore, I would probably look at this being a great year from the broad economic parameters perspective.
Right, well, so I actually wanted to shift focus to global events. We have an impending rate hike from the Fed, and we're also looking at the US presidential election that could possibly, change things for fund flows in India.
True.
With respect to both these events, what is your take? What does it mean for India?
So I think from an India perspective, I think it will more of inclusive growth. I think one of the big change that we are seeing in the last few years is coming, especially from India point of view, which I always have wished and we always thought that that's the way India will behave. Especially taking into account the inclusive growth I think India should bring about. And clearly we are seeing this time the inclusive growth is coming. But having said that, of course, some of the global noise cannot be ignored. The global noise is coming from 2-3 angles. One, of course, US interest rate is rising, and there is high probability the interest rates will go up. And second is the US presidential election may also actually put some amount of uncertainty. So therefore, for now till December, till the election outcome comes, we will probably see the market looking at various variables before taking a cognizant call.
Just before we come back to one more question, we just want to address the markets. I don't know if you can look behind us, but there's a big clapping and cheer given the markets that have opened. But we'll move on to the next question. I just wanted to understand, since you spoke about the global events which are imminent, how do you see the Indian markets moving over the next 2-3 quarters?
I think next 2-3 quarters, of course, we have variables such as international development need to be factored in, and so therefore we could see some bit of volatility in the market. But having said that, I think Indian market volatility in our view would be the least, given the fact that domestic inclusive growth is coming back. But next 2-3 quarters we'll see actually that we'll probably see, given the fact that what I mentioned earlier, that growth is coming back, we'll see actually the consumer durable goods actually the sales have been picking up, rural economy is driving, and the interest rates are coming down. All of them put together, if you see, you'll see actually the next 2-3 quarters consumer demand picking up. We'll also see the corporate earnings actually showing a better outcome. Also we see actually the overall supply glut which was there, where the supply was higher than the demand, that also now have been now narrowing down. We'll probably see the better corporate performance as we move forward.
I don't really see a lot of technology stocks in the top holdings of some of your funds. I just wanted to understand, what is your view on the IT sector? Do you think the Indian IT companies are not really prepared to face the challenge of the transformation that we're seeing, and of course the depressed global discretionary spends?
Yeah, clearly I think is IT sector is actually an interesting junction. One from the point of view of that the way the IT industry has been built in all these years, I think is undergoing a change. And given the fact the new technology is coming in, there are different ways of doing business which also is coming in. Therefore, I think one need to adapt to that change in the technology. And second is, having said that, the US economy picking up. I think the recent US GDP number may also actually warrant a lot of spending coming from the financial institutions globally. So therefore, we have to be prepared for some bit of uptick in terms of spending coming from US economy, which also may actually act as a revival for some of the IT sector's fortune. But having said that, that's a sector that has got reasonably good earnings, reasonably good balance sheet, also has a capability to adapt to the new change in the technology. So therefore, one has to just wait and watch in terms of how some of the companies are going to adapt themselves in the changing scenario, and therefore one can't go underweight significantly. Also, there is no reason actually one should go overweight in the sectors.
Well, okay, Mr. Subramaniam, thank you for all your views, and I hope you guys have found that interesting and exciting, and actually I found a lot of ideas that you guys can work on for this coming summer. Thank you once again.
Thank you.
And wishing
Thank you.
a happy Diwali.
It's my pleasure.
And,
Thank you.
Happy New Year.
Thank you.
So the markets have opened right now, and we are looking at somewhat of an uptick, but once again we are joined by yet another guest, and this time we're in conversation with Sir Ramesh Damani. Once again, thank you for joining us. Happy Diwali and a prosperous New Year.
Happy Diwali to both of you, and it's always a pleasure to be on your channel.
Right, sir.
I think I'll start with my questions. I just
Absolutely.
wanted to understand, correct me if I'm wrong, and I'm starting with this question because this is the biggest global event that we are coming closer to. I believe you belong to the camp that believe that Donald Trump would not really be will not emerge as a winner as far as the US presidential elections are concerned. Of late, the polls have only shown that the odds of him winning are increasing. So I just wanted to understand, if that were to happen, how would the Indian markets correct, and would that situation lead to you changing your preferred sectors in any ways?
It's a very long question, but let me get to it. Let's just wait for the opening bell to finish. It's a good question though. The race, America is known for its October surprises. A lot of bombs or grenades are thrown off in October, so you never know. We had it with Donald Trump's Access Hollywood tapes, and now with Hillary Clinton's email. So you're absolutely right. The race is tightening. The polls I read over this weekend is down to 2-3 points. Now, the way I think is, if Donald Trump pulls a Brexit type of victory and he does win, I still think it's very unlikely, but it's not a zero chance event. But if that happens, I think the markets are woefully underprepared for it. I would expect the Dow to be down 5%, Mexican market to be down 10%, and emerging markets to also widely sell off, because the markets are pricing in a Hillary Clinton victory, not a Donald Trump victory. Once the knee-jerk reaction is down, then we'll have to reevaluate our stance on which stocks to buy. Now, in terms of particular impact on India, Donald Trump has said 2 or 3 things which his supporters would want him to do after the election. The first, of course, is that he won't allow open immigration. So a lot of Indian tech support that going there might be hampered by new immigration laws in America. He's going to break down a lot of treaties like NAFTA, NATO, TPP, which promote free trade. In the last 50 years, all emerging markets have grown by exporting to America. I think that might be more constrained in the Donald Trump kind of world. So I think it will be broadly negative for equity markets, at least from the get-go. But on the other hand, he's a businessman and he's practical. So maybe if he's elected, he would not be as draconian as he was in order to get elected.
Right.
Okay.
But so, for our own markets, I know everyone's positive, and I know that you're positive on our markets too. What are the economic challenges that you foresee that we could see which could play a havoc, or not necessarily havoc, but could be a problem?
The 2 things that I'll point out. First of all, that India is in a sweet spot compared to other emerging markets. Our interest rates are going down, oil a big import component. All the regular reasons that analysts tout on yours and other channels, that India happens to be in a sweet spot. I think it will continue. The bull market began in India 3 years ago. It's still continuing. When bull markets age and when they top out, give you certain indications. I don't think we're seeing any of that right now.
Right.
So you're just saying getting vertigo from the heights which markets have risen. Stocks have doubled, quadrupled. Someone say, oh, maybe it's over. But there's no technical evidence to suggest that the market is topping out. The fear to the market can come from black swan events, things that we cannot anticipate. Donald Trump's victory is getting priced in. But increasingly, I'm very worried about, the so-called cybersecurity threat that the globe is facing. I read a CIA report this weekend which suggested that there will be only two kinds of companies left in the world. Companies that have been hacked and companies that will be hacked. So that points to something that could be huge disruption. Electricity grids, Internet of Things grid, banking, entertainment industry, whatever. So I would be very careful of that kind of event, and also say those are the kind of stocks that we should be looking for in case your viewers want some Diwali ideas.
Yes.
Okay, we have more ideas that we're going to ask you for, but Mr. Tamani, you've always said that you're very bullish on oil marketing companies and also real estate companies. One sector which has done well and one probably hasn't done well in the recent past. For somebody who wants to take a fresh position, do you think it is the correct time to enter real estate stocks given the oversupply situation and the leveraged balance sheets which we are still facing?
Well, you'll be surprised if you go back and study the indices. Real estate was among the top gainers in the
Recent past.
indexes this time. OMC has done very well. They're giving you bonuses plus they're giving you dividends. So both these sectors are surprisingly done, not surprisingly, but happily done very well in there. I remain bullish on them. The oil marketing company is the case for them in two sentences. They're cheap, they have good dividends payout, and they have pricing power for the first time in their lives. So they continue to do well. Real estate is a long call. I've often said that instead of trying to time the market, the time spent in the market is more important. So you have to believe that there's Indian population that's going to middle class, and the first big ticket aspirations will be for housing. So you want to buy the less leveraged companies with good brand names that have staying power through difficult times. So I continue to remain bullish on both these sectors.
Well, Mr. Damani, we speak to a fairly young audience, and I know that you believe in having a circle of competence. Can you explain that concept to our audiences, and can you also tell us about how to choose your stocks?
I'll tell you very simply by an anecdote. The two billionaires of the world, that's how they are. They all become friends, right? Billionaires become friends with people like us. They become friends with each other. Bill Gates, Warren Buffett, both certified billionaires became friends. They traveled to China together, been friends for 30 years. One day Buffett was asked at a press conference. He said, you're such pals with Bill Gates of Microsoft. You've traveled to China with him. You meet each other for Thanksgiving and Christmas. How come you never bought Microsoft? And Buffett's answer stunned me. He said, because it's outside my circle of competence. I understand candy business, I understand the credit card business. I don't understand technology. And that was the answer. So it's very important not only to know your circle of competence, but also to know its boundaries. And to give you an example of how people can use that, let's say you're an engineer. You can look at engineering stocks. Let's say you're a banker, look at banking stocks. So rather than try and follow 6,000 stocks that trade every day on the last street, try and follow the 50 or 100 in which you have some hedging. That is what the circle of competence is.
So any stocks or themes that you want to recommend to our viewers for the new Samvat?
I already hinted at in my previous answer that, and I'll put it in another way so that your viewers will understand it. Bank of America chairman, I was asked recently, was asked what his budget for cybersecurity was. And his answer, you think 10 million, 20 million, billion? No. He said unlimited. It's a huge threat that's like a freight train coming towards us, and we need to be very cognizant of that danger. So there'll be a lot of expenditure going on in that sector. So as a sunrise sector, I would suggest cybersecurity.
Okay.
Well, Mr. Damani, thank you for joining us once again. We want to wish you again a happy Diwali and a prosperous New Year. And I hope we can be in conversation with you again very soon.
Thank you both, and have a great year, both of you and your viewers.
Thank you so much, Mr. Damani. Thank you so much.
Well, so for now, we are looking at subdued movements as far as the markets are concerned. They have opened up. We're not looking at too much in terms of activity with respect to gainers or losers. But this is something which is typical of trading, because usually volumes tend to remain small and we don't have too much activity with respect to your futures and options trade either. But for now, we are looking at subdued movements, and I suppose we just have to wait and watch whether or not we do see a little more activity moving into the session.
We also have our next guest who is ready. We have Neelkant Mishra joining us, who's this, from Credit Suisse. Mr. Mishra, thank you so much for joining us on Bloomberg Quint on this day, and wish you a very, very happy Diwali.
Well, so Mr. Mishra, my first question was to do with the current challenges of the market. What are those macro challenges, and what do you think can steer the markets ahead?
See, since May this year, there has been a very visible slowdown in the economy, and many of the high frequency indicators we track, like oil volume growth, cement volume growth, power volume growth, even commercial vehicle sales, these have been reporting very weak numbers year on year. Till the trend starts to improve, that is the year on year comparisons start to improve, I think the confidence in FY18 and FY19 projections for the market will not appear. And till then, our view is that the broader market stays range bound. Now, FY18 in particular, given that it is going to see the start of the GST implementation. Now, while the medium-term outlook because of GST is, I think, much improved, I think it's a very epochal event in India's history. But as it gets implemented, it could actually disrupt the economy quite meaningfully. And the market, as you know, hates uncertainty. So the coming year, we could see some volatility. But of course, the shape of the market as we see it could be very different from what it is right now.
Well, okay, Mr. Mishra, what is it which will prompt the return of capital expenditure in full swing?
The challenge in India is that the sectors where there is private sector participation or where private sector participation is permitted, those sectors have meaningful overcapacity. So utilization levels are very low. Whereas the sectors where India needs capacity, which is say in power distribution, in roads, in railways, in sewage treatment, basically urban infrastructure, these have not yet been opened up fully for private sector participation. So in my view, it will have to be the government in using various creative forms of financing to kickstart the capex. And as sectors start to open up, you will start to see more private sector capex happening. Over the next 2-3 years, as utilization in some of these more corporate focused sectors starts to improve, you will see capex automatically coming back.
Well, so Mr. Mishra, my next question is to do with the consumption sector, and I want to break this up into consumer staples and consumer discretionary. So firstly, what is your reading on festive demand, and how are you viewing things moving along for the auto, paints, as well as consumer durables sector? And as opposed to that, what is your take on the consumer staples, because a lot out there believe that consumer staples is starting to become a little expensive?
Demand on the staple side has been quite weak. In fact, in the September quarter, our expectation is that the volume growth combined for the sector could be half of what it was last year, and perhaps the lowest in the last 2-3 years. See, the problem in staples is that the bottom of the pyramid is really struggling. Agricultural income growth, which was running at 14% CAGR between 2005 and 14, was only 5% in FY15, only 3% in FY16. And now with the good monsoons, while people expect that the incomes will revive, we expect that good volumes will actually drive prices down, and therefore the overall income growth may not be significant. And there is also, I think, a fear that the farmers are greatly indebted after 2 years of weak monsoons, and therefore whatever incomes they get, they could actually be just repaying their loans and not consuming. So staples, which is far more, I think, geared towards the bottom of the pyramid in terms of new adoption and upgrading, I think it has that problem. On the discretionary side, I think the numbers are looking quite decent. They're not as strong as we would have liked, but there is the advantage of better leverage. So there is a lot of financing now available. If you see two-wheelers, for example, 1 year back, only 35% of two-wheelers were financed. Now 55% of two-wheelers are financed. So the threshold for the income level at which you can adopt or you can afford a two-wheeler has come down, and that's showing up in very solid numbers. So I think availability of credit, and also the fact that there are meaningful changes happening in terms of power availability, in terms of roads availability across the states, and that should help the first half, the top half of the economy do well. And therefore on discretionary we remain overweight. On staples, as we discussed, the volume growth expectations in the coming years, we are not very positive on. And that is compounded by the fact that the PE multiples are actually quite high.
Well, could you leave us with an idea or two, whether sectoral or thematic, that you think will do well over the next 1 year?
So our out of consensus call over the past few months has been that interest rates will fall much more sharply than people think. We think that, and this was done before the RBI cut rates, that the rates could fall by 100 basis points. We could see interest rates reaching a level we haven't seen for close to a decade. And that means that there will be new opportunities in the stock markets. And that was about the time when we cut staples to neutral, and we went deeper underweight on IT and healthcare, and we upgraded construction companies to overweight for the first time ever in my role as a strategist. These are stocks, and this is the whole sector has 40 to 50% of their costs coming from interest and labor costs. So as interest costs fall, as labor costs don't appreciate as much because of the stress at the bottom of the pyramid, and order flows from the government side seem quite steady. In fact, many of them have seen significant accretion to their order books in this year. I think that this sector as a whole can actually do very well.
And finally, Mr. Mishra, you were one of the first people to call, the rally in the metal space. But the question now remains is, do they have more legs to go as far as, appreciation in this sector is concerned?
This is, I must emphasize, a trading call, and trading call for us is not the first half of the day, but it's actually more like 12-18 months. So we have been highlighting that this sector is underheld. What is also starting to happen is once the prices bottom out, metals and commodities in general have a lot of cyclical factors which accentuate moves on both sides. So you have on the one hand, currencies of commodity exporting countries that move along with commodity prices. There's a lot of cost, cyclicality in the cost curve itself. There is also this tendency of inventory cycles playing out around prices. So as prices are falling, no one wants to hold inventory. When prices rise, everyone wants to accumulate inventory. And I think those trends bottomed out sometime earlier this year. And then we started to turn positive. We upgraded a few stocks. We went overweight on the metal sector. I think that the cyclicality is still playing out. We have seen coking coal prices, for example, shoot up. We are seeing some mining projects which had slowed down now, cutting volume guidance on iron ore and coking coal. And therefore, I think there is still a lot of room left for this to happen. This is also, as I said, an underheld sector. So very few investors actually have positions in it. So as they start taking positions, I think they'll go up. And from a policy perspective, the problem was last year, you could have very easily said that, in 2019, iron ore could be $10 because there was absolutely no hope. Now what is starting to happen is that every single developed market, Japan, the Eurozone, the US, seems to be moving from a more monetary stimulus to a more fiscal stimulus. Now, I doubt that the stimulus is going to come up in the next 3-6 months. There's a lot of bureaucracy to wade through, a lot of political consensus building. But no one can say for sure that 2019 iron ore will be at $10. And that should give some comfort to investors into getting in. So we remain quite positive on the sector.
Well, thank you, Mr. Mishra, for joining us. Once again, wishing you a very happy Diwali and a prosperous New Year. But moving on to our next guest, we have Mr. Dipen Mehta joining us, and we'd like to wish you the same, a happy Diwali and a prosperous New Year.
Happy Diwali and a prosperous New Year to you and the entire team, as well as all your viewers.
Thank you. So, Mr. Mehta, I'm going to start off by asking you, we know that everyone is very bullish on the markets, but what are the challenges that you foresee in this coming summer?
Well, I think the biggest challenges may come from the overseas markets. And you have the US elections, although it seems to be like a done deal, but one cannot be so sure. And then there is the entire Eurozone, where problems keep cropping up. But all said and done, I think this low interest rates or negative interest rates globally, slow growth over there, certainly has its repercussions for our markets as well.
Right.
So that's the biggest threat as of now. Domestically, I don't see any major issues, but valuations are on the high side. So even if there's a slight miss on the performance, then stocks can get punished in a severe manner.
Right.
I was just looking at some of the stocks which have really done well in Samvat 2072, and if I look at the Nifty gainers, the top two names that come up are Hindalco and Tata Steel. One wouldn't have really expected the top gainers to be from the sector like metals, which has been facing a demand, a low demand sort of a situation. But they have rallied given the supply management and the various import duties. What I want to understand is there any metal stock that you like, or you think the whole rally has played out and you would rather keep away from them this year?
I think, see, the stocks you named, they've come back absolutely from very low priced, undervalued zone into fair valuation, because partly government action also, prices have stabilized and the companies themselves have taken corrective action. So, from being in negative, they at least now come, so to speak, at par. But going forward, I think I'm not that positive on commodities. If the slow growth persists overseas, then commodity prices will get impacted. And, it's better to look for businesses which are domestically focused, where we are seeing many positive triggers play out, like lower interest rates, good monsoon, or even for that matter the certain pay commission. So there are certain positive triggers and investors should focus on that, and these positive triggers will benefit domestically oriented businesses.
Right, so in your answer you've touched upon a few factors that could influence the consumption sector. So I want to actually break the consumption sector to staples and discretionary. We have seen mixed trends in auto, but a lot are out there believe that staples is looking expensive right now. How would you break these sectors up, and what is your view on this?
I think that you cannot paint the entire consumer-oriented sector with a single brush.
With a single brush, yes.
There are many, within staples also, there are many sub-segments which are mature, like say soaps, detergents, and there are many segments which are still growing at decent growth rates, like say cosmetics or insecticides or health products, health food. So you have to be a bit discerning about which type of staples or FMCG companies you're looking to invest in.
Right.
And my understanding is that by and large, the Indian FMCG companies continue to be quite dynamic in a scenario like this and are able to grow their businesses, so that's where the focus will be. And now the entire consumer-oriented space is expanding, so you've got autos in it, you've got building product companies in it, you've got appliances in it. And then at some stage you'll also get some of the other laggards in the consumer-oriented sector also playing out, like media entertainment has not done well, so they also start coming into play. Maybe real estate also, finally we'll see demand coming in from actual users.
Right.
So that also sector may benefit from lower interest rates as well as higher consumer demand. So it's going to be a process, but the investor has to keep an eye on companies which sell in India. That's the main message I would like to give this Samvat.
Right.
Okay. I also wanted to tell the viewers, I think your last Samvat picks included pharma names like Aurobindo, Kedala, Torrent Pharma. Anything in the pharma space that you like?
Not really. I think pharma is getting very tricky, and we are seeing a lot of volatility coming into their earnings. Large cap pharma is not able to grow at the same pace as we have been used to seeing them grow. And domestic pharma companies are getting affected by pricing policy. So I would like to be neutral to slightly underweight on pharma, and as I said, focus more on domestic businesses. Big industry you've not touched upon is financials, that's banks, NBFCs, consumer lenders. I think those have a great next few quarters, and you may not expect these companies to maybe trade at a higher PE valuation, but the underlying earnings growth is going to be strong, and these stocks will definitely track the earnings growth that these companies can deliver.
Ms. Mehta, you've also spoken about the defense sector, in this case specifically BEL. Why do you like that stock, and can you tell us about reasons behind why you are so bullish?
First, a disclosure that we and our clients are invested in Bharat Electronics.
Right.
And it's in a unique position because it's a PSU, so obviously for the security clearances, all the protocols are in place. They certainly get price benefit or volume benefit when they're bidding for government orders. So that's one big advantage in a sensitive area like defense. You always have an advantage if you're a public sector organization.
Right.
Secondly, its track record has been exceptionally good. Even under very trying times, we've been able to deliver steady growth. It's a well-managed company, good quality balance sheet. And what I like the most is that lately the order book position has been really bulging.
Right.
And as of now, they have got almost 4 years of order book in position. And many more tenders are coming in which will benefit them.
Right.
So I expect that from a 9% type of a growth rate over the past 4-5 years or so, they should easily be able to up it to 15-17%, maybe higher as well. But it's at the end of the day a capital goods manufacturing company.
Right.
So one should definitely factor in some more of volatility in quarter-to-quarter earnings.
Right.
All right, just last question. A lot of people are telling us that they've started to look at construction stocks given the way they have underperformed. Your view on that sector?
Well, I think by construction, do you mean real estate or do you mean EPC construction?
EPC companies.
Yeah, well, within the EPC space, I think order books are definitely bulging over there, and at some point performance will come through. But these are not high quality businesses, and investors will not give them a premium valuation, and they have a checkered past. So you may have trading opportunities depending upon order flow and performance, but by and large, I'm not that positive on engineering and construction companies. Though I'd like to leave you with one idea. We are positive with usual disclosure that we and our clients are invested on a company called IL&FS Transmission, and that is basically a BOT operator, India's largest build-own transfer operator for highways as well as metros. And the big play over there is reduction in interest rates and how they improve the quality of their debt and how they deleverage themselves through transferring some of the projects to maybe an investment trust.
Right.
And lowering of the interest costs will certainly be a big story for this company in the current year.
Okay, so I'm not going to talk about BEL and IL&FS transportation, which I'm assuming will be some of your top picks, but you've also spoken about Inox Leisure and Care. Could you tell us a little more? That will be our final question.
Yeah, well, Inox Leisure, we were disappointed with the numbers, but that's the nature of the beast. There is volatility in the earnings over there. But it's a secular growth story because more and more people are going to visit multiplexes. Even the younger generation, despite having streaming entertainment, look towards going to multiplexes. So that's a positive trend. And in the media sector, media entertainment sector, after online media, the fastest growing sector is the film production and distribution.
Right.
And there are very few plays available in that particular sub-segment, which is why exhibition companies like PVR and Inox are our top picks over there. And the company, that entire sector benefits tremendously when GST is implemented. And we could go into that as some other points. So that's one part. And the other company is credit rating, care rating. What we like over there is that, again, regulatory changes, more buoyancy in the debt market, increased volume of debt issuances will benefit a company like Care, and operating leverages will certainly play in because they don't have very high variable costs.
Right.
And there are certain very strong regulatory push being given for companies to get their debt products rated. There is a kind of a trend for larger companies to move away from bank finance to debt markets, and that benefits this company. And there are many encouragement given to small SMEs and medium-sized enterprises to get their debt rated and to get bank financing.
Right.
So we are quite positive on that company. But these are all long-term picks, and we look at these companies from a 3 to 5 year type of a period, all the companies are described. And we, as I said, reiterate, we and our clients are well invested in that.
Yeah, sure.
Thank you so much for your time, and we leave you with season's greetings. Thank you so much for joining us. Next, we have lined up with us Mr. Deven Choksi, the Managing Director at KR Choksi Securities. Welcome, sir. Thank you so much for joining us at Bloomberg Quint, and wish you a very, very happy Diwali from our end.
Thank you very much, and wish you all a happy Diwali as well. And looking forward to 2073 as a great year for all of us.
I hope that it's a great year too. Yeah.
Totally. Mr. Deven, where do you think the markets are headed, and what could be the key themes and the macro factors which should really drive markets further from here?
I think the market rhythm is already set. So I think whether you look at the capex program implemented by India, whether you look at corporate sector taking up various initiatives, I think the market rhythm is already set. And for one, I think I would not like to draw any boundary this time around, because the size of the opportunity itself is becoming so huge that to limit the market momentum to 9,000 or 10,000 Nifty index, I think would be silly thing. On the contrary, I think one should probably start looking at individual stocks and where the potential is huge. Many of the large cap companies have been neglected by this market in the name of trading or uncertainties. I think this is going to be the time wherein you will see some of the large cap companies driving the market values up.
But Mr. Choksi, some concerns with respect to this year.
concerns would always remain, and according to me, I think these concerns are not going to go away immediately.
Yeah.
My own take is that I think given the situation in which we are right now, probably I think we will have to play those concerns. When the market gives an opportunity at lower levels, I think we will have to buy at lower levels. That is how I would like to position myself.
And how are you using, we're coming up with two very important events in the US right now. First, of course, is the US presidential election, and second is the impending rate hike. Now, that to a certain extent has played out. Do you think, what sort of an impact can this have on our markets?
Well, both are known events. Let's put it this way.
Yes.
So once it is known, then I think the market has factored it, safe to assume.
Right.
Second thing, before you become a president and after you become a president, I think there is always going to be a situation. I think before you can always make noise, and thereafter I think you will have to listen to the voice. So certainly my reading says that I think it's not going to be so bad as people are fearing about. Even if I think, God forbid, I think if Mr. Trump comes as the president of the United States, I think the people of the United States are going to see to it that I think he behaves properly. So I would not like, I think, to carry undue weightage of this particular situation on my head. Rather, I would think that I think there is no better choice than India for US today, because the equation with China, probably if you look at the macro levels, I think they are not working good as much as I think they thought about. With India, I think the equations are already set. So maybe I think they would like to run this equation for their own growth. So I would remain a little bit more positive, though uncertainty would continue for a while.
Okay. Before we move on to equities, just off the market question, I just wanted to understand what is your view on gold as an asset class? A lot of investors have actually told us, in fact, one of the fund managers also told us that we should invest in gold, not invest in gold, but invest in gold and entrepreneurs. And what is your view on gold?
There is one good say that I think if you want to buy gold on Diwali and sell on Murat Day. That is Diwali Day.
Okay.
Because I think we are driven by emotions and sentiments. My reading says that I think gold as an asset class, probably you are not finding the inherent demand picking up for this asset class. On the contrary, the financial instruments which have been created, the gold bonds particularly, the ETFs, I would start believing that I think majority of the people who are investing in gold, they would like to invest in paper gold vis-a-vis the physical gold. So if the physical gold demand is not improving, then maybe the larger part of the run in the gold, I don't think that I think is going to last for long. Because of the easy liquidity situation in the global market, I think it is continuing, but it may not last for long. Whereas I think the compounding rate of return in equity could be much higher, because we are seeing 15 to 20% kind of a growth happening in earnings of the equity vis-a-vis practically I think stagnant growth in gold. So I would rather put my money to growth where I think it would run faster.
So Mr. Choksi, you know what, there is one sector which really hasn't seen a lot of focus in the recent times. Not at least in media, we haven't spoken about it that much. I'm talking about capital goods. And I know that you have a few companies in your research that you are tracking. I think one of them is Schneider Infra, there's GET&D, and I think to a certain extent ABB. Can you tell us a little more about this?
Well, why we have chosen this particular area? Because if you look at the amount of investment which is happening now in transmission and distribution segment is now increasing faster, because the generation capacities are happening in all the generating modes, which is I think hydel as well as alternate energy segments. Now to evacuate this energy and transmit it, I think you require investment in transmission segment. And this is where these companies are very well positioned. In fact, up till now, I think they have been struggling more because they would not get money from the state electricity board. After this Uday scheme and after this particular state level financing arrangement which has taken place, I would like to believe that I think the tough time for this business is over. On the contrary, I think they could look forward to a better time going forward, and that is why I think we have selected these companies. We believe that I think these companies could really participate well and could give better returns, and most of the global parents have started putting in larger money into these businesses. So one can probably keep an eye on them. Maybe it would be too late to buy, I think, after a few years. So maybe general investors can probably look at these companies now and then sit on them. Probably I think it could give 20-25% CAGR at the end of 3 years.
Since you are here, we cannot let you go without asking you about Reliance Industries. The earnings are out. We know what plans they have announced. What does one do with Reliance Industries now?
Yes, so right. I think the earnings are good. Company has already completed the capex program. The refining capacity is now 100 million tons. They have already been running the petrochemical segment at rated capacity, and the newer segments in petrochemical, newer streams in petrochemical are now getting started also. So the capex program to the conventional business is over. Fortunately, the capex program largely is over for even the geo business. And if you look at geo business, geo they have capitalized an enterprise value of around 2 lakh to 2 lakh 50,000 crores. Generally, we would like to believe that I think such large scale businesses, when they capitalize to this level, they would add one time to the market capitalization. Reliance's own market cap today is 3.5 lakh crores.
Right.
If you see 2.5 lakh crore worth of market cap getting added eventually, I think Reliance is promising to give you 60, 70, 80% kind of a return going forward. With all the capex programs over, with the feedstock coke gasification project getting started, which will bring down the raw material cost for the refining segment also, according to me, I think Reliance could be the one I think which could drive the index to newer levels. I think it could carry really, I think, a heavy weight on the index to drive it on the higher side.
NBFCs were the, so as to say, the hot sectors or the top sectors, best performing sectors of Samvat 2072. What do you think could be the next NBFC, the next year, a new sector or a theme which you really think will really do as well as this one has done?
Clearly, it would be insurance.
Okay.
The country is putting across, I think, a large part of investment. About $1 trillion worth of investment is going in capex programs, and even more thereafter. The country is underinsured at this point of time, the non-life insurance as well as the life insurance segment. And it is this business which could possibly have a smarter run going forward in next 10 years. I would like to believe that I think the way in which the private banking space was in 90s, insurance is actually in the similar kind of a situation today. Most of the private insurance companies have completed 10 to 15 years of their operations in the country, and they have absorbed the initial level of cost stroke losses. Now they are into the profit ventures. My reading says that I think those who are planning insurance for next 10 years, they could make a larger part of the wealth out of this segment in markets going forward.
Right. Well, I actually also wanted to quiz you about the agricultural space, and once again, I believe you have some interest in EPC and gen irrigation. Can you tell us a little more about that?
Well, again, I think we have selected this agri space very carefully because a large part of the population up till now in last 2 years because of the drought situation was very badly affected. Micro irrigation segment is one segment which is, I believe, I think is going to track larger tractions now, because government has very clearly started the move of, I think, removing the subsidies even from agricultural space and give breathing space to farmers. Should that happen, the benefit would directly go to the companies.
Right.
And my reading says that I think water conservation is important for the government, so they would encourage more and more micro irrigation. Given that situation, both EPC and Jain, both of them are in a, I think, relatively much smarter situation today than they were before. Subsidy is still a little overhang, but I guess I think they would overcome that area as well. And that's the reason for which we believe that I think if you are planning for next 2 to 3 years, micro irrigation within the agriculture space and the crop protection in the seed business could be the businesses I think which you should be holding on to. Could end up getting some 25-30% return if you are holding on for next 3 years.
Right. Finally, Mr. Choksi, a few tips or maybe some ideas that you can leave our audiences with.
Well, I believe that I think most of the companies which we have put across in our investment recommendation, we believe that I think we have even started discussing with some names also. I think couple of places where I believe that the growth is going to be higher is in the area of digitalization.
Right.
The companies which are engaged in extending the reach to the consumer through the digitalization process, I think they would be the ones I think would be definitely driving the markets and the valuations also. So Reliance Jio is part of Reliance, so we are not talking about that as of now.
Right.
But the companies which are basically supporting Reliance Jio, if you start looking at, I think companies which are in the fiber optics and fiber optic cables. If you look at, I think, company like Sterlite Technologies within that, that company has got even the smart city projects to drive their growth. It's one important area where I think the growth could be much faster, so one can look at that company. The companies which are in the supply, content supply businesses, they look, I think, interestingly positioned. And we believe that I think the content supply business of network eating group of companies could possibly be the next driver of growth for through Reliance Jio kind of a platform. So selectively one could look at I think these areas where one will probably find better opportunities going forward. And my viewpoint is at least 2 to 3 years of investment. So I am sure I think multiplier rate will come as far as the investment return is concerned.
Thank you so much, Mr. Levin, for joining us, and I hope that leaves our viewers with a lot of options that a lot of names that he's spoken about. Thank you so much for joining us.
All the best to you.
Happy Diwali and a prosperous New Year.
Thank you and wish you all same.
All right, sir. We also have waiting with us Mr. Nilesh Shah, CEO and MD at Envision Capital. Nilesh, a very happy Diwali and a prosperous New Year from our team.
Wishing all the viewers and their families a very happy Diwali, a happy Samvat, and a very, very prosperous New Year.
Well, Nilesh, what are the macro trends this summer that you're watching which will guide the Indian markets even higher?
Well, India's macros haven't looked as good as they have in recent times. So clearly, I think India is on an upward trajectory. The next 12 months are likely to see India witnessing and sustaining a GDP growth in excess of 7%, a significantly toned down inflation, and perhaps the RBI continuing with its policy to cut interest rates. So I think macros for India are good and are likely to get even better over the next year or so.
So, Nilesh, in our recent conversation, you had mentioned the consumer discretionary space on which you are very positively placed. But how has festive demand been so far? What is your reading in this sector? And has your call in this sector changed?
Well, we like the sector, especially from a structural opportunity that it presents, given that the per capita of India is about $1,600 to $1,700, and we think that about anywhere between $1,800 to $2,000 per capita is a very, very strong inflection point by then. And from there onwards, I think the demand for a lot of products in the consumer space could kind of get into a hyper growth mode. But having said that, I think the festive demand has not shaped up precisely in the manner that it should have. So obviously we'll get to know more about that when the December quarter numbers are out. But I don't think the September quarter numbers are anything to offer cheer from a pure specific festive point of view. But having said that, we still think that probably the December numbers would be a better proxy, and I think the long-term outlook still remains unchanged as far as the discretionary consumer space is concerned.
Well, Nilesh, what has been your early reading on the earnings, and what does that really mean for how the entire FY17 will turn out to be?
Well, the good news is that I think we've seen some margin expansion, and I think clearly it's been the margin expansion which have contributed to the earnings growth so far. So I think the first half has kind of gone off on a margin note, where commodity prices, of course, are up over say a 6-month horizon, but nevertheless on a year-on-year basis they are still benign for most producers and for most corporates. I think in the second half, what we will continue to see is basically the impact of lower interest rates. Interest rates have come off significantly over the last 12 months, and I think that will start contributing positively to a lot of sectors. So that's one. And two is that the enhanced liquidity coming in because of 7th pay commission, the OROP, a favorable monsoon, a bit of pickup in the rural demand. I think all of that should also start contributing to top line growth. So our sense is that the second half of this financial year is likely to be better versus the first half of this financial year.
So Nilesh, we've seen a very good correction in realty prices, and by that I mean property prices. But for now, my next question will have to do with how would you compare that as an opportunity, that is to invest in property, as against investing in stocks of property developers? How would you go about it, and what would be your preference?
Undoubtedly realty stocks, there's no doubt about it. I think real estate prices, property prices, I'd be surprised if they appreciate meaningfully over the next 3 to 5 years. given that the prices in some pockets are at elevated levels and that prices have been held up. So I'd be surprised if prices go up from here in terms of real estate, actual real estate. But I think some of the very well managed property developers, I think are in a position over the next 3 to 5 years to be able to kind of execute well, deleverage balance sheets and bring about delta in their earnings. And given that basically the sector is tremendously beaten off, we think that over the next 3 to 5 years, there is room for a contra play or a contra investment in real estate stocks.
Well, a lot of IT sector earnings have been very lackluster this time around, but the prices have corrected. So do you really look at it as a opportunity to buy in terms of the lower valuations, or is it clearly a sector that you would avoid?
I think the large caps are still an avoid. Unless you are an institutional investor and you have that institutional imperative to make allocations to technology sector and you need to kind of therefore be in the mega caps. So I think you'd probably be content with an 8 to 10% top line growth in that space. But I think if you were to kind of dig a little deeper and get into the mid cap, the tier 2 names, I think they're growing at a far more higher pace versus the big boys. And I think there the valuations are relatively attractive. So I think if we were to kind of take a view on technology, we like the long-term prospects of the technology sector, but it's just that in terms of relative positioning, I think we would clearly be in favor of the tier 2 and the mid-cap names versus the larger names.
And finally, Nilesh, if you can leave us with some ideas for this Samvat that our audiences can take a look at and consider for their investments.
I think there are three set of opportunities that we kind of are liking, and I think we believe we have excellent names in them. So clearly, I think the discretionary consumer space within that, we own in our portfolios Mahindra Holidays. We like that. We think there's a lot of headroom for growth. They've been executing very well, and I think over the medium to long term, I think that could be an important wealth creator. Specialized engineering is something that we like, and within that we own a name called Engineers India. We believe that there is likely to be a revival of capex in the hydrocarbon sector and the refining space. So that's the second area that we like. And third, of course, is in the banking and financial services space. We are big believers of financial inclusion, and therefore the newly set up IDFC Bank, which has an aspiration to become a mass retail bank, we believe valuations are attractive, and I think if they execute well over the medium to long term, I think that could be one more strong candidate for a potential wealth creation.
Thank you so much for that. But Agam, on an overall basis, I think people have still maintained their belief that we are in a uptrend. The market is in an uptrend. We're still in a bull market, and we also saw a lot of people who actually came and told us that any volatility or correction that they see in the markets because of the upcoming events will rather be an opportunity to buy. So I think even the kind of FI outflows that we've been seeing over the past few weeks, I don't think that has really deterred some of our Indian investors, and they only seem positive as far as the next year also is concerned.
That's an interesting point, but we have to remember that the FII outflow that we've seen in the last couple of weeks has also been the highest that we've seen since February this year. Now, this also means that we have seen a lot of volatility across the world, and while the FIs have continued to sell, we have seen DIIs dip in, and of course the retail investors dip in. So if you consider the Nifty, it's still at 8,700 despite the fact that we have seen a substantial outflow, and it is not really not a very big figure, but it's still a substantial outflow. But the fact that the Nifty is currently somewhere around 8,700, 8,600, moving within a range, well, it certainly speaks for the confidence of the retail investors, the HNIs, and your domestic institutions in the way they are looking at our own equity markets, and that's also reflected in maybe not a tremendous performance with respect to other asset classes, because we know that gold isn't having a tremendous time, certainly not in the last 3 to 4 months. We have seen weakness in realty space, of course. We have seen prices move in many months, and perhaps in a couple of years, and we are seeing on the flip side a lot of strength in equity. So it certainly is a positive stance, as far as our equity markets are concerned.
I think even as far as the bond markets are concerned, I think a lot of most of the rallies already been played out. We've seen interest rates falling from those 8% sort of levels to below 7% now, 6.7% sort of number is where the 10-year bond yield is trading at. So, and in fact, we're also expecting one more repo rate cut to come from the RBI before we end the financial year, that is March, by March 2017. So yes, it does seem like equities are in a good spot right now, given the fact that bond markets have already priced some of this in. So probably equities is the best place to be in, and this is of course all our market guys will tell you, but of course a really long-term perspective is something that is required. Having said that, again, consumption continues to remain the theme that everybody has spoken into, so probably that is also going to continue into the next year. But we also have joining us Alex, who's standing at Marine Drive. He's going to give us a check of how that entire festive mood and the spirit there is. Alex.
This, according to me, is one of the most beautiful locations in Mumbai. Whether it's early in the morning or at sunset or even after the sun has gone down, there's something special about Marine Drive that draws people to it. And today especially, with the lights on across this entire stretch, this perhaps becomes the most idyllic location in Mumbai for the celebration of Diwali, the festival of lights. As you can see behind me, people have been celebrating as soon as it became dark, as soon as the lights came on, and there's actually a lot of smoke from the fireworks that have been going off behind me. What's even more beautiful, however, and why a lot of people congregate here, is to watch what happens in the distance. There are uncoordinated fireworks displays that are beautiful nonetheless, and that a lot of people come here every year to watch. One such family is actually standing right beside me, and I'm going to ask him to join me. Nilesh, can you bring your family here? I want to talk to you for a very short while. Thank you so much for speaking to Bloomberg Quint.
Thank you.
Nilesh, first up, you told me, why don't you come this way? Come this way. Yeah. So Nilesh, you told me, when I told you about what we were doing in terms of coverage at Bloomberg Quint, we said that the Mohra trading is going on. And you said that you're a trader as well, and that you trade on the long side.
Correct.
Can you just tell me how this year has been? Not a lot of people have been happy with it.
Yeah.
But how has it been for you as a retail trader?
The market has been volatile, but nevertheless, we are hoping that the year goes through. It has been quite a fruitful year, and the coming year also we expect that the market will be going up and up.
Okay.
That is what every investor expects.
Let's hope you're right. As they say, "Aapke muh mein ghee shakkar." For both for you and for all of the investors sitting there watching us. Now, do you come here on a regular basis every Diwali?
No, coincidentally, this is my first visit here.
Okay.
Even though I have been born and brought up in Mumbai,
Okay.
but I have come here for the first time on Diwali day.
Okay. And do you like what you see so far? Do you like Marine Drive?
Yes, I am enjoying very much.
Okay.
I come here on odd days, but not on Diwali day. But this is my first visit on the Diwali day.
Okay. So Nilesh's family right here is just one of many families. You can actually see a lot of them bursting firecrackers. There are people watching what we're doing here. But just as a favor to us, and I'm sure Nilesh has family elsewhere, I'm sure you guys have family elsewhere, you'd like to say Happy Diwali to all of them, and also to all the people that are watching and will watch this broadcast. So on the count of three, I'm gonna wish all of you a very happy Diwali with them. So 1, 2, 3. Happy Diwali!
Okay, so Alex seems to have enjoyed with that family. But joining us next, we have Mr. Pashupati Advani. Thank you so much for joining us, sir, and wish you a very, very happy Diwali.
Likewise, thank you very much for having me, and welcome to your channel.
So, I'll start with my question. We've been asking everybody how Samvat 2073 looks like, and of course everybody believes that the bull market uptrend is still intact. I want to understand, what do you think is something that could go wrong or probably put some sort of a break to this rally?
I think the next thing that could go wrong is a guy called Donald Trump who's sitting in America.
Okay.
Actually there's been a lot of events that have happened that have surprised people. I mean, Brexit is one of them, and it's actually kind of shell-shocked the British economy quite seriously. So much so that the financial services companies are moving out of UK and looking to set up in Frankfurt. And these are only, obviously if an event happens, it'll take time. But I read in the paper today that Donald Trump's last poll is only 2 points behind Hillary Clinton. So if he actually makes it to the White House, I think there's going to be a lot of issues, a lot of protectionism, and the walls are going to be up in metaphorically a lot more places than just on the Mexican border.
Right, but so you have mentioned about Trump, but right now, of course, the markets are factoring the Hillary Clinton win. With that, do you expect the scenario in the US to change, or will it be the same? Because we are also hearing a lot of complaints, and not necessarily complaints, but some amount of negative sentiment with respect to Hillary Clinton as well.
Well, I think it's a question of between the devil and the deep blue sea. And
right.
People are not happy with either candidate.
Yes.
And, there's a joke going around that the Queen wants to be the write-in candidate so she can take over the US again.
Yeah.
But the thing is that, again, this problem of the emails is surfacing. Maybe something will come out of that, in which case she may actually get disqualified. So he'll get in despite himself. Because both the vice president candidates don't seem to have much exposure in terms of the international media and are not considered to be presence.
Yeah.
So that is a challenge. But the thing is, if Donald Trump does make it, it's going to be a changed world, because he is not beholden to the party system, and he's actually going to make some changes which are going to hurt a lot of people, and I think will hurt the world.
So in that event, if we were to see any significant correction coming in, obviously India is not going to be spared either if that were to happen. Would you use that as an opportunity to buy? Would you advise your investors to buy, or would you rather let the volatility play out and a clearer picture emerge?
See, one of the things that I actually see that he will probably use protectionism is in the IT sector, where we have a lot of business going into the US. There already are some barriers in the sense of high cost of visas, difficulty in getting visas, but that's currently being sort of counterweight by the fact that with electronics and the cloud and all, it's easier to do stuff from here. But the reality is, tomorrow he says no Indian IT in the US. It is going to affect that sector, and that's the kind of force majeure event that could hurt a lot of people. But again, he's doing this against China. He also wants to stop Chinese goods going into America, and he wants to give jobs back to America. So he's well intentioned, but he doesn't care who he bruises. And as you said, Hillary Clinton, Trump, they're also both in their late 60s, early 70s.
Right.
So that's another challenge, to be fighting the elections with a 8-year horizon going forward as an American president. So that's another tough one. She actually fell ill during the campaign, and she was taken aside. So these are the next tough things. And I've also just returned back from UK, and they are beginning to feel the effects of Brexit.
Right.
On the one hand, foreigners are there buying stuff because London is supposed to be the new luxury goods capital of the world because of the currency. But the reality is, that British jobs are going. A lot of the banking jobs are shifting overseas. A lot of the insurance jobs are shifting overseas. So those are going to be challenges, because those are the ones that bring business into the mainstay of UK.
Right.
So those are the challenges.
Okay, so IT is one sector that you believe could bear the brunt of the outcome of the US presidential elections. Pharma is another sector which is heavily dependent on the US for its revenues and bigger margins. What do you see happening to pharma?
See, I think in the case of pharma, they need pharma more than they need IT. To develop manufacturing capability is going to be difficult in the US in a hurry. Yes, it can be done in time, but so therefore I think pharma is going to is still in better position than IT. And I think that our pharma people have actually been doing some IP work, and they're picking up actual patents and things like that, and they're doing research. So they're gradually moving up the value chain, and I think that's going to help them.
Well, in that case, I want some of the sectoral bets that you're playing for this particular year.
Again, I think the domestic consumption story is good. After a long time, the oil marketing subsidies have gone. I think that's a space to be with lower oil. They're getting competitive. There's no need for subsidies. So I think that, and the public is paying prices except for LPG and kerosene, which also is gradually happening with the subsidies.
But you don't reckon that the consumption space is looking a little expensive?
Well, I think more and more people are coming out of the woodwork with aspirational, and the consumption is increasing.
Right.
I mean, one of the things is one of the crazy things is people are starting to eat more chicken, and I think that's going to cause a lot of anguish. But there's a cost involved, and it's also going to shift the whole agricultural sort of universe of our country. But these are things that are slightly more long term. But everyone is aspiring to dress in the best clothes like Shah Rukh Khan does, or be in the movies, or be in be a sports person. So that's everyone's aspirational dream. And we're getting people from all over the country with those dreams, and it's great. It really is great.
What about financials, whether we're talking about NBFCs or if you're talking about banks, PSU banks, private sector banks, how does that space look now? What amongst the three themes is something that could outperform?
Well, everything is going to be driven by the availability of credit as people get into more and more high-paid jobs. And I think that anyone who provides that credit, whether it's an NBFC, whether it's a Paytm or a free charge that's going to be in that space, or whether it's going to be the public sector banks. The private sector banks are already there, but they're looking for tier 2 and tier 3 towns to be the next stage of growth. And anyone who's got a reach, those are the people who are going to make money. So you actually have to go through the balance sheets, see who's actually got presence in these, where there's less competition, and those are the guys who are going to be the winners. But definitely, financial inclusion is going to be the next wave as well.
But given the way, do you believe that PSU banks are at a structural disadvantage right now, given the way, because of the NPA issues and the fact that they've been more focused on corporate lending, they've actually lost significant market share to some of the private banks structurally, even on a 3 to 5 year basis. Do you really think these can bounce back?
Yeah, because I think the government is going to fund them. I think that they're going to have to fund them. The reality is that the public sector banks are in the rural areas and they have the reach. And as long as they can keep the deposits coming in, and the money, supply flowing, I think those are the things that are going to make the economy grow. It's a multiplier effect. And I think that's what they have to be. And anyone who's out there, but again, today you've got cash money, soon it will be electronic money, and everyone's mobile phone is going to be their bank. So maybe the game will shift to the Reliance Jio, or to Idea Telecom, or Airtel, or Vodafone. Maybe Vodafone's also trying to get listed. Maybe those are going to be the flavors of the year.
Right. Okay, so with respect to Tata Group, and I'm sure you're privy with what's happening right now.
I wish.
We all wish. But, so in the realm of speculation, we're assuming that the Shapoorji Pallonji Group moves out, which means that they, sell their shareholding in the Tata Group stocks. What will it mean for Tata Group stocks? And will that be an opportunity if there is a substantial correction to buy into Tata Group stocks?
See, I'll tell you, I think there's a lot more that is still to come out. I don't think that either side is doing this for the money. And I think both sides are able to withstand, any loss in market value that is there, because they're not in it for the 1 year, 2 years, they're in it for the long haul.
Right.
So, will it make them better businesses? Yes. We care about how the operating companies are operating. Yes, as shareholders we do. What's happening up there, of less relevance.
Right.
Except that we'd like to see direction, and we'd like to see whether it's going to be driven by Ratan Tata, and for how long, and what is his succession plan, or whether it's going to come back to the mystery, to Cyrus mystery, and with a slightly different agenda, or whether it's going to go back to Cyrus mystery with his old agenda. So we don't know how that's going to play out. But short term, there is concern about the value of the group, and it's already lost about 7 or 8 billion in the last since the news, and will probably lose a little bit more. But I think that if they continue to do some of the things that they've been doing, like settle with Docomo in a sensible manner, plus they're doing some work with Tata Steel in Europe, I think if those deals actually go through, then I think that confidence will come back into them. So I think that's what we're looking for. We cannot comment on what's going on in Tata Sons, but we obviously can feel what's happening in Tata Steel and Tata JLR, Tata Motors.
Right.
And those are the ones we're interested in. And they made 3 bets when the market was going straight up. One was steel, one was automobiles, and one was beverages. 2 out of 3 did well.
Right,
okay?
right.
I mean, who could have seen in 2007 it was like, the streets were paved with gold. And, nobody, people look at what happened in .coms in 2000. So, they made a bad bet, but they made some good bets too.
Right.
All right. Thank you very much for joining us, Mr. Advani, and once again wish you a very happy Diwali.
Likewise.
Thank you
To
so
you
much.
too. Bye.
We also have Alex who's back with us. Alex,
there are people that have come to watch fireworks more so than burst fireworks themselves. But that's what a few families have told me. It's more about the experience of togetherness, about spending a day out with your family and celebrating Diwali as really a family occasion more than anything else. But they're hoping that next year will be much better than the year that has gone by. With that, it's back to you.
Well, we are going to go over to the temple that we are seeing there, and yeah, let's walk over.
So we're actually moving towards.
I think most of the people have
where the
moved
puja is
out,
being
given
held,
that the
and
markets
as you
have
can see, we'll just
closed
slowly
now.
be
But
focusing
we still
towards,
have
the deity.
the last few set of
And
people staying here. But this is the first time I'm seeing these. This is the first time I'm seeing this beautiful way that they've done up this entire place and the bell jagam.
Right, absolutely. And I suppose this also, tells us about everything that we are looking forward to and looking to. So why don't we just move ahead and actually, take the blessings of the gods.
That's correct.
Go and look down.
All right.
Well, I suppose that should conclude and help conclude our session, Mora Trading. I hope that you guys have had a fantastic session. I also hope that you guys have a great Samvat 2073. And along with that, we wish you a very happy New Year and a blessed Diwali. Thank you for tuning in. I hope that you have got a lot from our trading session today with all the conversations that we had with all our guests, along with the top picks that you can make good wealth, stay healthy, and once again, wishing you a happy Diwali and a happy New Year.
Yes.
Thank you very much.
And do stay tuned to Bloomberg Quint as always. See you guys.